Hello, hello. Yeah. Hello, students. So, this is CACS Pushkaraj Vishnu Joshi, and we are together for ICWA final paper 20A, that is Strategic Performance Management and Business Valuations, in short called as SP and BB. And this is a syllabus that we have been together for. Section A already done. Section B, we are done with 5, 6, 7 module, and we have started with 8 module. And the 8th module is all about valuation of assets and liabilities, and in that module we have around 8 chapters, of which today I will be taking up the 3rd chapter, which is about valuation of investments, shares and bonds or debentures. So that's what the name of the chapter is. And as my process has been, or as I have been advised, I am covering the entire study material chapters that are there in the study material given by the institute, so that you have some reference points to even look upon or fall back on the material. So out of that study material, the respective chapters, summarization, concising, and in a way crisply and precisely covering the concepts, theoretical concepts that have been explained in detail in the study material, has been my coverage in the various sessions that I have been taking for this subject. So if at all you have to deep dive more into the topic, you have to refer to study material, and obviously for practical solutions and problems, they are elaborately detailed out in the study material itself. So let's begin. Valuation of investments and investments, especially shares and bonds and debentures. So valuation of investments, shares and bonds or debentures. Let's understand the types of investments. So common types of investments include, in between I am just rectifying the PPT also to some extent in terms of presentation. Yeah. Sure. So the types of investment, typically the common types which are prevalent and popular also include shares and bonds. Now bonds and debentures are used interchangeably, because the characteristics of both bonds and debentures or features in terms of as a financial instrument are absolutely one and the same. They have a fixed maturity, they have fixed interest rate, the amount is fixed, the type of mode of interest that will be given as a return on investment would be by way of interest, either periodically, monthly, bi-monthly, quarterly, half yearly or yearly, as the case may be. So the common types include shares and bonds and debentures used interchangeably. Investments may be for short-term or long-term purposes, and this duration for which the investment is being made classifies or is accordingly the investments gets classified either as short-term or long-term. So normally the investment which are invested for a period of holding period of 1 year to 3 years are called as short-term. Beyond that, they are long-term. So that's what the prominent bifurcation of time duration, which in a way gets constituted either as a short-term or a long-term instrument or investment, is that. Thirdly, entities may hold minority or majority stakes in companies. So investments in shares in a way may lead to holding a minority interest or majority stakes in a particular company, depending on how much percentage of investment in shares have been made. Accordingly, the minority or majority stake gets classified, and that's how the investment in equity is being done. Accounting treatment wise, there are specifically, sorry, there are specific accounting standards wherein the investments are to be recorded at cost. There is a Indian accounting standard Ind AS which requires fair value valuation in specific cases of investments. So the cost of investment, as the accounting standard suggests, record investments at cost. So cost on investment includes acquisition charges like brokerage, duties and fees. Obviously, if at all you are investing into a particular financial instrument through a broker, then there may be some brokerage charges. So at the same time there would be some duties and fees also that will be levied. All those gets added as cost of investment. So acquisition charges like brokerage, duties and fees gets added. If acquired via securities, cost is equal to fair value of securities issued. And if exchange for another asset, then the cost is equal to fair value of asset given up. In terms of amalgamations, mergers, etc., at times whenever whatever the business is getting merged, in lieu of that business, the acquiring company will, or the amalgamating company or amalgamated company will issue shares as a payment, as a part of consideration. So if shares are being issued in lieu of the business, then the fair value of business or asset will be considered as the cost. So income on such investments like interest or dividends may sometimes be recovery of cost and not income. So these are the components of cost of investment, and or you can say cost of investment includes acquisition cost, charges if acquired via securities, then the cost is equal to fair value of securities issued. If exchange for another asset, cost is equal to fair value of asset given up. And income like interest or dividends may sometimes be a recovery of cost and not considered as income. Now let's understand the special cases for income allocation. So special cases for income allocation: if interest or dividends include amounts accrued pre-acquisition, the pre-acquisition portion is deducted from cost. So that's what income allocation, the way it is treated. If difficult to separate such income, then reduce investment cost only if clearly a recovery cost, then only the investment interest or dividend is to be reduced. Valuation of quoted securities. Now minority investment in quoted shares valued using market quotes. So minority investments in quoted shares are valued using market quotes, because obviously they are quoted shares. That's why market quotes are available, and in that case that market quotes becomes a referral point for valuation of quoted securities, especially in case of minority investments. Sometimes the volume weighted average price, that is VWAP, what is called as, is used over a few sessions for accuracy, because the typical certain shares are quoted in the market and market quotes are available. In such scenario, sometimes the volume weighted average price is considered. The valuation of, in case of unquoted shares, now if suppose a particular investment of shares is being done and those shares are not quoted, then how the valuation is to be done? Let's see. The valuation of unquoted shares typically carried at cost in financial but may require valuation. Valuation approaches are typically cost, income, market, or a combination of any of the three approaches. In absence of data, use net asset value method, that is asset minus liability with fair value of adjustments as such. This is how the valuation of unquoted shares is being done. So typically carried at cost in financials, but may require valuation. Valuation approaches typically includes cost, income, and market value approach, or a combination of all the three, any of the three. In absence of data, the net asset value method is used, wherein assets are reduced, liabilities are reduced from assets with adjustments for their respective fair value. Now such adjustments to fair value adjustments, common fair value adjustments that are included are adjustments often needed for land, underlying investments, and contingent liabilities as such. So for these three purposes, the fair value adjustments are required to be done. Now, so this was all about investment in shares. Now let's understand valuation of bonds. So definition and characteristics of bonds. Typically bonds are fixed income securities issued by governments or corporates. Interest on bond is typically tax deductible for issuers, and bonds act as a liability for the issuer. Why? Because while issuing those typical bonds, the money is borrowed against those bonds. So in a way, the investor invests in lieu of the bonds that are being issued to the investor. So that's why, in a way, for the companies, it's a borrowing being made from the retail investors or corporate investors, as the case may be, and therefore bond acts as liabilities for the issuer. The key terminologies that are associated with bonds as such are coupon. So coupon is the fixed interest rate paid periodically. Example, semi-annually, monthly, bi-monthly, quarterly, half-yearly, or annually. So half yearly means semi-annually. So that's coupon, interest rate, fixed interest rate. Bond yield, required rate of return may differ from the coupon rate. Obviously, required rate of return is different vis-a-vis the coupon rate. Face value, nominal amount on which interest is paid, is face value. Maturity date, final date when bond is going to get repaid. So that's the date when the liability is going to cease, or liability is going to get honored or paid, or the obligation to pay will be done. So that's the maturity date. Redemption premium. So redemption premium typically means additional amount paid over face value of maturity. So additional amount paid over face value at maturity is redemption premium. Then another terminology that is used is bond price. So quoted as a percentage of face value. Example, 105% of 5,000. That means rupees 5250 is the bond price. Then there are certain options that are available or attached to a particular bond. Now those options could be call option. Call option in a way allows issuer to redeem bond from before maturity. So in a way the issuer calls back the instrument, and in a way while calling back the instrument he has to repay the amount, redeem the bond before maturity, redeem the maturity amount before maturity. So that's call option. And in put option, it allows the bond holder, that is the investor, to sell bond back to the issuer before maturity. So that's what call and put option is. So call option is for the issuer and put option is for the bond holder. And in a way, for put option, bond holder is allowed to sell back the bond to the issuer before maturity. Bond types. Now there are, depending on the characteristics of the bonds, the features of the bond, the terms that are being used for the bonds, the types of bonds will get classified. So first type of bond is secured bonds, which are backed by collateral. So backed means secured by collateral. So in short, there is some kind of a security that is available, or assurance that is being made available for the borrowings that are being done. So secured bonds, so backed by collateral. Unsecured bonds, no backing, and hence therefore they are riskier than compared to other bonds. Convertible bonds. Now these are bonds which are converted into equity either fully or partially at a later point in date or upon occurrence of an event. So in short, they are quasi shares only. So for a particular period of time up till when the event is yet to happen, the instrument will be bonds. However, after a particular date or a event or a trigger, those bonds will get converted into equity. So in short, earlier borrowings which were made from the retail investors or bondholders, these bondholders upon convertible bonds or upon bonds getting converted into equity shares becomes the shareholders. So that's what convertible bonds are. Non-convertible bonds means plain vanilla, cannot be typically converted into equity. They remain till maturity as bonds and liability only for the issuer. Now let's understand the bond valuation formula. Bond valuation formula is value is equal to annual interest into present value annuity factor plus redemption value into discount factor. So these are the parameters over here. So let's understand current yield, that is CY. CY is equal to coupon rate divided by current market price. If the current yield is at par, current yield will be the coupon rate. At premium, current yield will be less than the coupon rate, and at discount the current yield will be more than the coupon rate. And however, this particular current yield has limitations because it ignores capital gains or losses. Then comes YTM, that is yield to maturity. So IRR, that is internal rate of return of bond cash flows, is interest plus redemption. Ideal measure of returning assuming so YTM is the ideal measure of a return assuming that bond is held to maturity and payments are timely and reinvested at YTM. So approximation formula typically for YTM is equal to C plus F minus P divided by N. All this put together divided by F plus P2. So C is the coupon, R is the redemption value, P is the purchase price, and N is the number of years. So that's the approximation formula. Then comes the realized yield. Realized yield means typically actual return based on reinvestment rate and holding period. It lies between the YTM and the reinvestment rate. So that's what realized yield will be. Zero coupon bonds means no periodic interest, issued at discount, redeem at par. So in a way, the entire return is realized at maturity. Then comes price yield relationship. So it is always inverse. As required yield increases, bond prices reduces. So inversely proportional price and yield relationship. So the moment a yield is increasing, price will decrease. Price time relationship. So in case of price, how the time relationship will be? So it approaches face value as bond nears maturity, and premium bonds reduce in prices whereas discount bond increases. So that's how the relationship of price and time is. Coupon minus price is equal to yield relationship. So again, YTM is equal to coupon rate is coupon rate. If YTN is the coupon rate, then price is equal to face value. If YTM is greater than coupon rate, then the price is, then the face value discount. If YTM is more than coupon rate, then price is greater than face value, which means it is issued at premium. Then comes the duration and interest rate risk. So duration means measures weighted average time to receive cash flows. It indicates interest rate sensitivity, that is 1% yield change is percentage price change. Higher duration is equal to higher interest rate risk. Lower duration is associated with higher coupons, shorter securities, and higher YTM. Maculae duration is one of the concept, which means weighted average time to recoup bond cost via cash flows, and it is equal to amount is equal to maturity for zero coupon bonds, and which is less for coupons. So maculae duration typically measures that weighted average time to recoup bond costs via cash flows, and is equal to maturity for zero coupon bonds less for coupon bonds. Then comes the concept of modified duration. So modified duration price sensitivity measure the percentage change in value per 1% change, yield change. That's the relationship, and it is derived from maculae duration. Now let's understand the risk in bond investment. So there are, obviously, being a market related instrument, there are various risks that are associated with such investments. So the risk in bond investment includes interest rate risk, reinvestment risk, call risk, and default risk. Now let's understand each of these risk concept. So interest rate risk is that the bond prices fall when interest rates rise, and it is measured via modified duration, and the factors includes demand, supply of money, inflation, policies, business cycles. Second is the reinvestment risk. Now the reinvestment risk is the future cash flows reinvested at lower rates than original coupon, and affects callable and amortizing securities more. Call risk is issuer may redeem bonds early if interest rates drop, and reduces cash flow certainty and potential returns. And lastly, the default risk is risk of issuer failing to pay interest or principal, evaluated using credit ratings. Example, CRISIL, S&P, that is Standards and Poor's, one of the credit rating agency, internationally renowned. And third is the Moody's. So again, that is also internationally recognized international rating agency called Moody's. So S&P and Moody's are the international rating agencies, and CRISIL, CARE, etc. are the Indian rating agencies. So in short, the risk in bond investments includes interest rate, because the bond prices fall when the interest rates rise, and it is measured via modified duration, and the factors on which it depends are the demand and supply of money, inflation, policy, business cycles. Call risk is, obviously, issuer may redeem the bond early, and reduces cash flow certainty and potential returns. Default risk is risk of issuer failing to pay interest or principal, evaluated using rating agencies, credit ratings, sorry. So this is you can say the credit rating pattern followed for the by the three rating agencies. So this table typically has been picked up from the study material itself, and in that, if you see the various meaning or the interpretations of various ratings have been mentioned. So AAA is like prime rated instrument. Then AA2 or AA is high grade rated. So and so forth. These are the B1, BAA1, BAA2, BAA3, etc. So all these are the way the credit rating agencies rate a particular investment, and especially the bond investment, bond paper. So coming ahead, the credit risk classification. So bonds may also fall under C and D series ratings, indicating higher vulnerability and risk. Secondly, there could be inflation risk also. So inflation risk typically, just a second. So current yield is coupon interest divided by current market price. At par, in case of at par, coupon, the current yield is equal to coupon rate. At premium, current yield is more than the coupon rate. At discount, current yield is less than coupon rate. Limitation, it ignores the, sorry, I think the slide has got copied. Sorry, yeah. So the credit risk classification. So these are typically nothing but credit risks that are being given by the various rating agencies to the bonds. And each rating type has a meaning attached to it in terms of the credit rating. So credit risk classification, bonds may also fall under C and D series ratings, indicating higher vulnerability and risk. Inflation risk is another category of risk that is associated. Inflation risk means purchasing power risk. Now over here what happens is that the risk that bond yields don't keep up with the inflation is possible. So the rate of inflation might not match with the bond yield rate as such. Then in a way it means it erodes real return if coupon rate is less than inflation rate. It affects fixed rate bonds more than floating rate bonds. And tips. So tips are nothing but treasury inflation protected securities help counter this in the US. So in US, to counter the inflation risk, there are treasury inflation protected securities that are being issued, obviously, and therefore it is prominent in US and it helps to counter the inflation risk that is possibly impacting the bonds. Another concept is the another type of risk is the yield curve risk. Now yield curve risk arises from uneven changes in interest rates across different maturities. The rate duration measures price sensitivity to interest rate changes at a specific maturity. The portfolio duration assumes uniform interest rate changes across maturities. And call and prepayment risk refer to early repayment of the bonds affecting the returns. Then few more category of risks that are risk in bond investments are that liquidity risk. So risk of selling a bond below its indicated market value. It is measured by the bid-ask spread in the market, and liquidity risk fluctuates over a period of time. Another category of risk associated with bonds is the exchange rate risk. This occurs when bond payments are in foreign currency and risk that foreign currency declines versus investors' domestic currency. Volatility risk is also another risk associated with the bonds, and volatility risk in this risk is tied up to expected changes in yield volatility, especially for bonds with options. Callable bonds, in case of callable bonds, risk increases with higher volatility, and in putable bonds, risk increases with lower volatility. So these are the characteristics of volatility associated with the bond. Then comes the event risk. In event risk arises from unexpected events. Example, natural disasters, takeovers, regulatory shifts, etc., which impacts the issuer's ability to pay. And lastly, sovereign risk. Typically, so this is a risk that foreign government actions lead to bond default or price drops, and investment grade bonds rated AAA to AA. So below BB are speculative, high yield and junk bonds in a way. Yeah, so sovereign risk is the risk from the government. So risk that foreign government actions lead to bond default or price drops. Investment grade bonds are typically rated AAA or from AAA to double B. Below double B, it means are speculative or high yield or junk bonds. Now let's understand callable bonds. Callable bonds are those bonds where issuer can redeem the bond before maturity. In a way, it has advantage to the issuer and disadvantage to the holder, because held to maturity concept might get compromised over here, and that's why it's callable bonds. So issuer has a right to redeem the bond early before the maturity also. Deferred call includes bond cannot be called for a set number of years after issue. So there is a compulsory holding period in a way, and hence it's called as a deferred call. So second is a call date. So first date, the bond can be redeemed by issuer itself. So that's called as call date. And there is something called call price, which is usually the face value plus 1 year's interest when first callable. Puttable bond. So these are the characteristics of puttable bond. Bondholder has a right, not obligation, to sell the bond back to the issuer at a set price on specific dates. The price of a puttable bond is equal to price of option from free bond plus value of embedded put option. So this is a formula in a way of puttable bonds. Now valuation complexities are there in such bond valuation. Embedded options. So if at all there are embedded options like call, put or convertible, which makes bond valuation more complex. Valuation requires modeling of interest rates and issuer behavior to estimate the cash flows. Now let's understand the price behavior. So price behavior, in a way, callable bond prices fall less when interest rates rise due to declining value of a call option, and convertible bond value depends on share price, which is tied to conversion ratio and market value. So convertible bonds are bondholder can convert bonds into a specified number of issuer share. Conversion is attractive only when share price into conversion ratio is more than or equal to bond par value. If conversion value is less than par, bond behaves more like a traditional bond, that is straight debt. Now, how valuing convertible bonds, especially for private firms. So split into straight bond value and conversion option value. Example via Black-Scholes model. So this is how valuation of convertible bonds is done, especially by private firms. Now comes the concept of valuation of warrants. So valuation of warrant definition means an option issued by a company to buy a specific number of shares at a predetermined price. That's called as a warrant. Typically issued with debt or preferred stock to make those securities more attractive. It is the detachable warrants can be separated and traded per se. So typically issued with, so an option, so warrant definition wise, an option issued by a company to buy a specific number of shares at a predetermined price, typically issued with debt or preferred stock to make those securities more attractive. Detachable warrants can be separated and traded independently. Most warrants are always detachable. So that's what the instrument is being created in relation to a bond as warrants. So warrant versus convertible securities. Convertible securities convert directly into common stock. No exchange, no cash exchange is involved. And warrants require payment of cash along with surrender of the warrant into acquire stock. Minimum value of a warrant. So 0 when stock price is below the exercise price. Gains positive value once stock price exceeds the exercise price. And value growth is influenced by the exercise ratio, which is number of shares per warrant. What is meant by warrant premium? Investors pay a premium due to limited downside, loss capped at warrant cost, and higher upside potential. Give me just 2 minutes. Yeah. So the factors influencing warrant premium include stock price to exercise price ratio, wherein higher ratio leads to lower premium due to reduced leverage. Time to expiration, less time reduces premium. Investors' expectations of capital gains are that optimism increases the premium, and volatility of underlying stock, greater volatility raises the premium. So that's what factors influence the warrant premium as such. Now let's understand the preference shares, overview of preference shares. Preference shares are a hybrid security combining features of both equity and debt. Preference shareholders have priority over equity shareholders during liquidation or bankruptcy. Typically pay fixed dividends resembling debt instruments. So why they are hybrid? Typically because in a way the preference shareholders have priority over equity shareholders during liquidation of bankruptcy. And secondly, typically these instruments are required to be paid fixed dividends resembling debt instrument like a fixed interest cost. So valuation formula, if dividends are constant and shares are perpetual, value is equal to preference dividend divided by required rate of return. Secondly, in India, preference shares have a maximum life of 20 years, making them either redeemable, repaid at the end of term, or convertible into equity shares. So, no preference share can be issued which are redeemable more than 20 years. That's what it means. At the end of 20 years, either the shares have to be redeemed, that is repaid at the end of the term, or those shares have to be converted into equity shares. The key characteristics of preference dividend in preference shares includes dividend features. One is a cumulative dividend. So in such case, unpaid dividends accrue and must be paid before equity dividends. Non-cumulative means unpaid dividends do not accrue. So there is no accumulation of dividends that have happened in case any dividend is unpaid. Thirdly, participating means can share in excess earnings beyond fixed dividend. And non-participating means limited to the fixed dividend only. Liquidation preference, entitled to pay out before equity shareholders during company dissolution. Voting right wise usually limited but may exist in certain cases, and only then in such cases the voting rights are restricted to the respective class of preference shares only. So liquidation preference entitled to pay out before equity shareholders during company dissolution. Voting right wise usually limited but may exist in certain cases. The put option feature is there in these preference shares. Some preference shares allows investors to force repurchase by the company at a fixed price. Then comes each of these features of preference shares influence the value of preference shares, either increasing or decreasing their appeal depending on investor preferences and market conditions. The table below highlights them. So this table is from the study material itself. So if you see increases the value and decreases the value. So if the preference share is convertible into equity shares, then it increases value. If it is non-convertible, then it decreases the value. If the preference shares has cumulative dividend, it increases the value. If the preference shares are non-cumulative, then it decreases the value. If the preference shares are participating, then it increases the value. If they are non-participating, it decreases the value. The put option is there in preference shares, then it increases the value. If there is no option, then it decreases the value. If there is high call price, that is redeemable, then it increases the value. If low call price, then it reduces the value. And voting rights, if at all are there, then it increases the value, and non-voting right in a way decreases the value. So this is the way the value of preferences gets influenced either by increase or decrease of the various factors or features of preference shares. So with this, the typical chapter ends over here. As I said, the entire module has very limited theoretical concept in the chapter, and therefore with this the chapter per se in the study material ends. However, as a matter of practice, I have been following for the sessions. I am taking up the short question and answer and the long question and answer, the concepts that are being discussed in the short question and answer respectively, and as well as long question and answer respectively. So in short question and answer, one is about explaining the terminology of the bond. So define terms such as current yield, yield to maturity, and realized yield. Now this is what has been explained or is required to be explained to answer such kind of a short question. So current yield is coupon interest over current market price. YTM, that is yield to maturity, is the return rate from bond investment to date of maturity. Realized yield is yield actually earned, and refer to the definitions given in the, just a second. Second question and answer deals with the describing the procedure for valuing zero coupon bonds. So zero coupon bond value comes from redemption price discounted by growth rate and interest investment duration. In third short answer, based on the valuation of bonds formula, can you calculate the future value of a bond? In valuation of bond formula, coupon bond value equals annual interest times present value annuity factor plus redemption value times discount factor. So that's the formula, the way valuation of bonds formula is. Then short question and answer number 5. Sorry. I think I have made a mistake in the numbering. Let me just check whether we have 5 questions only or not. I'm just checking whether I have missed any short question and answer. Valuation of investments. No, I think I have missed one. Yeah. So review and discuss the fundamental assumptions underlying YTM. So assumptions include coupon and principal payments made on schedule, and bonds yield to maturity, coupons reinvested at same rate. Short question answer 5 deals with the price time relationship and the impact on bond prices. So price time relationship impacts bond prices as they approach So question and answer number 5 deals with how does the price time relationship impact the bond prices. So price time relationship impacts the bond prices as they approach maturity, and secondly premium bonds decrease in price while discount bonds increase. And the last short question answer, how do call option and put option affect bond holders. So call option allows issuer to call back the bonds and redeem them before maturity, potentially at lower rates, and put option allows bondholders to opt. Just a second. Yeah. So how do call options and put option affect bondholders? The call option allows issuer to call back the bonds and redeem them before maturity, potentially at lower rates, and put option allows bondholders to put the bonds back to the issuer for redemption and thus potentially benefit from higher current rates. Yeah, so with this, in a way, we conclude the chapter or theory which has been covered in the syllabus of the study material that has been provided. As a matter of practice, I will quickly summarize or recap the entire session or the study material covering the chapter. So we started with valuation of investments, especially of shares and bonds or debentures. We saw the types of investment wherein we covered the common types include shares and bonds. Bonds and debentures are used interchangeably. Investments may be for short-term or long-term purposes also. And entities may hold minority or majority stakes in companies. Then we saw the accounting treatment. As per the accounting standards, the investments are to be recorded at cost. And secondly, Ind AS, that is Indian accounting standard, which are aligned with IFRS, requires fair valuation in specific cases. The cost of investment includes acquisition charges like brokerage, duties and fees. If acquired via securities, cost is equal to fair value of securities issued. If exchanged for another asset, then cost is equal to fair value of asset given up. Income like interest or dividends may sometimes be a recovery of cost, not income. Special cases for income allocation: if interest or dividends include amounts accrued at pre-acquisition portion is deducted from cost. If difficult to separate, reduce investment cost only if clearly a recovery of cost. Then valuation of quoted shares: minority investment in quoted shares valued using market quotes, and sometimes use volume weighted average price over a few sessions for accuracy. Valuation of unquoted shares includes typically carried at cost in financials but may require valuation. Valuation approaches are cost, income, market, or a combination of any of the three valuation approaches. In absence of data, use net asset value method, asset minus liability with fair value adjustments. Common fair value adjustments typically includes adjustments often needed for land, underlying investments, and contingent liabilities. Valuation of bonds, then we saw the definition and characteristics. Bonds are fixed income securities issued by governments or corporates. Interest on bonds is typically tax deductible for issuers, and bonds act as a liabilities for the issuers. Key terminologies that are involved are coupon, which means fixed interest rate paid periodically. Example, semi-annually, monthly, bi-monthly, half-yearly, or annually also. Bond yield is the required rate of return, may differ from the coupon rate. Face value is the nominal amount on which interest is paid. Maturity date includes final date when bond is repaid. And redemption premium, additional amount paid over face value at maturity. Bond price is quoted as a percentage of face value. Example, 105% of 5,000. So that means 5250. Call option means allows issuer to redeem bond before maturity, and put option allows bondholder to sell bond back to issuer before maturity. Bond types: secured bonds backed by collateral, unsecured bonds no backing, riskier. Just a second. Yeah, so the bond price is equal to, is the quoted as a percentage of face value, example 105% of 5000, that is 5250. Call option allows issuer to redeem bond before maturity, and put option allows bondholder to sell bond back to issuer before maturity. Bond types typically are the characteristics basis which the classification of bonds happen. So secured bonds are backed by collateral, unsecured bonds are no backing, and hence they are riskier. Convertible bonds can be converted into equity fully or partially. Non-convertible bonds cannot be converted into equity. Then we saw the bond valuation formula, which is value is equal to actual annual interest into present value of annuity factor plus redemption value into discount factor. Current yield is equal to coupon interest divided by current market price. Then we saw at par current price is equal to coupon rate, at premium current price current yield is less than coupon rate, and at discount current yield is more than coupon rate. However, there is a limitation, it ignores capital gains and losses. Yield to maturity means IRR of bond cash flows, which are typically interest plus redemption. Ideal measure of return assuming bond is held to maturity and repayments are timely and reinvested at YTM. Approximation formula is YTM is equal to C plus F minus P divided by N, and all put together divided by F plus P2. So where C is the coupon, F is the redemption value, P is the purchase price, and N is the number of years. Then we saw the various concepts like realized yield. Realized yield is the actual return based on reinvestment rate and holding period. It lies between YTM and reinvestment rate. Zero coupon bonds, so no periodic interest, issued at discount, redeemed at par. Entire return is realized at maturity. Price yield relationship inverse, as required yield increases, bond prices reduces. Price time relationship approaches face value as bond nears maturity, and premium bond decreases in price when discount bond increases. Coupon price yield relationship, YTM is equal to coupon rate, wherein price is equal to face value. If YTM is more than coupon rate, then price is less than face value, that means at discount. And if YTM is less than coupon rate, then it means price is more than face value, that is at premium. Then we saw the duration and interest rate risk. So duration measures weighted average time to receive cash flows, indicates interest rate sensitivity, that is 1% yield change means percentage price change. Higher duration is equal to higher interest rate risk, and lower duration is associated with higher coupons, market maturities, short maturities, and higher YTM. So there we saw macular duration. Macular duration is the weighted average time to recoup bond cost via cash flows, equal to maturity for zero coupon bonds and less for coupon bonds. Then we saw the modified duration. Modified duration is the price sensitivity measure, wherein percentage change in value per 1% yield change derived from maculae duration. Then we saw the various types of risk in bond investments. One is the interest rate risk, wherein bond prices fall when interest rates rise, measured via modified duration. Factors that influence the interest rate are the demand supply of money, inflation and policies, and the business cycle. Reinvestment risk includes future cash flows reinvested at lower rates than original coupon, affects callable and amortizing securities more. Call risk, issuer may redeem bonds early if interest rates drop, reduces cash flow certainty and potential returns. Default risk, risk of issuer failing to pay interest or principal, evaluated using credit ratings, CRISIL and S&P Moody's. So this is how the typical credit rating is done. The table has been picked up from the study material itself. Then there are further more risks associated to the bonds: credit risk classification, inflation risk, yield curve risk, then liquidity risk, exchange rate risk, volatility risk, event risk, and sovereign risk. Then we saw the callable bonds. Issuer can redeem the bond before maturity, advantage to the issuer, disadvantage to holder. Deferred call, bond cannot be called for a set number of years after issue. Call date is the first date the bond can be redeemed by issuer, and call price is usually face value plus 1 year's interest when first callable. Putable bonds, typically bondholders has a right, not obligation, to sell the bond back to the issuer at a set price on specific dates. The price of a putable bond is equal to price of option free bond plus value of embedded put option. Valuation complexities are that embedded options, call, put or convertible make bond valuation more complex. However, it requires modeling of interest rates and issuer behavior to estimate cash flows also. Then we saw the price behavior. Callable bond prices fall less when interest rates rise, and convertible bond value depends on share price tied to conversion ratio and market value. Convertible bonds, bondholders can convert bonds into a specified number of issuer share. Conversion is attractive only when share price into conversion ratio is more than or equal to bond par value. If conversion value is less than par, then bond behaves more like a traditional bond, that is straight debt. Then valuing convertible bonds, especially for the private ones, split into straight bond value and conversion option value. Example via Black-Scholes model. Then we saw the valuation of warrants, wherein warrant definition we saw. Then we saw how warrant versus convertible securities distinction is. Then minimum value of a warrant is 0 when stock price is below the exercise price, gains positive value once stock price exceeds the exercise price. Value growth is influenced by the exercise ratio, number of shares per warrant. Warrant premium is the investors pay a premium due to limited downside, loss capped and warrant cost, and high upside potential. Then we saw the factors influencing warrant premium, and they were primarily just a presentation. So factors that influence the warrant premium are investors' expectations of capital gains, optimism increases the premium, volatility of underlying stock, greater volatility raises the premium, stock price to exercise ratio, higher ratio leads to lower premium due to reduce leverage. Then we saw overview of preference shares. It's a hybrid security combining features of both equity and debt. Preference shareholders have priority over equity shareholders during liquidation or bankruptcy. Typically pay fixed dividends as, resembling debt instrument. The valuation formula: if dividends are constant and shares are perpetual, value is equal to preference dividend divided by the required rate of return. In India, preference shares are not perpetual and have a maximum life of 20 years, making them either redeemable, that is repaid at end of term, or convertible into equity shares. Then we saw the key characteristics of preference shares. Dividend features includes cumulative, which means unpaid dividends accrued and must be paid before equity dividends. Non-cumulative, unpaid dividends do not accrue. Participating dividend means can share in exchange in excess earnings beyond fixed dividend, and non-participating means limited to the fixed dividend only. Most of the time they are non-participating. Liquidation preference, entitled to payout before equity shareholders during company liquidation or dissolution. Voting rights usually limited as a class of shares only, but may exist in certain cases. Put option features, some preference shares allow investors to force purchase by the company at a fixed price. This is how this table in a way features the various features influence the value of preference shares, either increasing or decreasing their appeal depending on investors' preference and market conditions. So the increase in value happens if the preference shares are convertible, cumulative, participating, have a put option, and high call price, is redeemable and having voting rights. And the value gets decreases when the preference shares are non-convertible, non-cumulative, non-participating, no option, low call price, and they are having non-voting. Then we saw the short question and answer only, which is long question and answer are not there in the chapter. So short question and answer, we dealt with terminology of the bond, and especially we saw the definition of current yield, yield to maturity, realized yield. Then we saw the procedure for valuing zero coupon bonds. Zero coupon bond value comes from redemption price discounted by growth. Just a second. Hello. Yeah. So then we took the short answers basically wherein explaining the terminology of the bond, define terms such as current yield, yield to maturity, realized yield, and describe your procedure for valuing zero coupon bonds. So zero coupon bond value comes from the redemption price discounted by growth rate and investment duration. Based on the valuation of bonds formula, one can calculate the future value of bonds by following. In valuation of bond formula, coupon bond value equals annual interest times present value annuity factor plus the redemption value times the discount factor. And then we saw the short question answer number 4, wherein we review and discuss the fundamental assumptions underlying YTM calculation. So the assumptions include so the coupon and principal payments made on the schedule, and bonds held to maturity, coupons reinvested at same rate. How does the price time relationship impact the bond prices? So price time relationship impacts the bond prices as they approach maturity. Premium bonds decrease in price while discount bonds increase. And how do call option and put option affect bondholders? Call option allows issuer to call back the bonds and redeem them on before maturity, potentially at lower rates, and put option allows bondholders to put the bonds back to the issuer for redemption and thus potentially benefit from higher current rates. So with this we end the chapter, and typically conclude the session also, and see you. So this is signing off, CACS Pushkaraj Vishnu Joshi, and we will continue with the rest of the sessions or the rest of the chapters on this module, and the subsequent module also which is pending. And therefore signing off here, CACS Pushkaraj Vishnu. Stay tuned. Let's rejoin on the next session. Bye bye. Thank you.